The US dollar has a significant role in the S&P and the stock market as a whole. Due to its high valuation, the US dollar has been keeping most assets in check this year. The value of the dollar has decreased recently. The truth is, though, that it's still quite high, likely much too high for healthy risk asset markets. So in terms of the S&P, that's helping us out a little. Furthermore, a lot of it is purely technical. On a weekly chart, you can see that we're hitting some extremely strong resistance near the 4,100 level. On a weekly chart, there are a few trend lines that enter the picture. One is the downward trend line, which began early last year and has held through the specific position. The other is that on the chart I'm showing, there is a blue line that goes all the way back to 2018 and represents the market's trading pattern up until all the COVID stimulus and government stimulus drove us over that trading range. Therefore, that pivot number will be quite significant. We can continue to have pressure as long as the market remains below that. It's actually quite bullish if we can't break through 4,100. There are undoubtedly some unanswered questions above the market, so I'm not sure we can accomplish it without a little more turbulence. Markets often perform rather well in November and December, but suffer in January and February, as we will see in the first quarter. The market has a difficult time exiting. Pay attention to the indexes as a whole rather than any specific industries. But given that, it's pretty clear that customers are turning away from discretionary things and toward essentials. There is a significant divergence between oil stocks and the oil futures market, which has been declining for several weeks while oil stocks have been rising as a result of this factor. It merely states that investors are in need. They are scrambling to find a place to invest their money. Oil stocks have been effective. Therefore, that is where they are investing their money. That will presumably continue to be the case until that quits working. The current state of cryptography. It goes without saying that the industry has suffered a terrible hit at the end of this year. Therefore, if we focus on Bitcoin especially at this time, we can say that it is still under intense pressure and that there are rumors that it will reach 14K. Since I have a hard time seeing the underlying value of Bitcoin, we don't really have a fundamental perspective on it. Cryptographic technology is unquestionably valuable. Simply put, I'm not certain that any one coin will survive the wash. Many of those tech stocks lost money, which made it possible for other businesses that came after them to succeed greatly. As an illustration, consider the contrast between the success of TrueCar.com and the failure of Pets.com. Therefore, just though some coins are present and being exchanged today does not guarantee that they will endure. Having said that, Bitcoin is a topic that receives a lot of attention from speculators and is a popular topic of conversation. We have a chance of seeing Bitcoin reach 8,000, which would bring us back to a very long-term trend line that began in 2019. According to the chart, I should definitely buy it between 12,000 and 608,000 at least. To be honest, I would tend to go more toward 8,000. The upside, in my opinion, is not nearly as promising as what we've already seen from there. Therefore, I wouldn't anticipate 70,000 or even 50,000. Perhaps we will partially retrace that sell-off. This places us in the $40,000 to $50,000 bracket, maybe. Now let's discuss gold. A lot of extremely knowledgeable and experienced traders have struggled with the gold and silver markets because they aren't acting at all how you would expect them to in a time of war or inflation. Gold has been a very disappointing asset. Gold and other assets are, nevertheless, being held back by the US dollar. The increased dollar valuation is hurting the stock market and treasuries, but if the dollar does roll over, it should essentially unhitch the plow on gold and silver and enable it to rise in sympathy with some of these fundamental storylines that haven't worked out so far. As a result, gold will underperform in 2022. The year 2023 will be favorable for gold and silver prices, focusing on a pivot point that is roughly 1775. In essence, this was the uptrend line from 2018 to 2019, and it did break through and fall earlier this year. But from a charting perspective, we're going back and retesting the idea that prior support has now generally turned into resistance. Therefore, the 1775 areas are currently a point of resistance on the way back up, and certain moving averages will line up around 1800. As a result, gold has a decent possibility of retesting if we can break over 1800. The old high is really rising somewhat, possibly as high as 2100 at some point in 2019. Another thing to bear in mind is that the middle of December marks the seasonal bottom for gold. Seasonal changes can be challenging because they can occur early, mid, or late. It occasionally doesn't function at all. However, if you seek for a location to go long gold, doing so around early to mid-December is typically a smart long-term move. Silver is therefore intriguing. In the short term, the silver chart is actually marginally more encouraging than the gold chart. On the silver daily chart, you can see that we sort of breached a downtrend line earlier this month, or rather last month, and that means we are technically in a breakout phase. The path of least resistance is upward as long as we maintain our position above 2050 in silver. We will finally receive what all the silver bugs have been requesting all year long if we can break the 20 to 45 barrier. We regress slightly and reach the high 20s or even the 30s, possibly next year. Yes, it will take some time and the dollar needs to change in order for this to happen. As a result, the dollar benefits greatly from a number of factors, including the interest rate differential and the Federal Reserve members' constant manipulation of the market by talking down treasury bonds and up the dollar. But a large portion of that has already been factored into the price. We also had some flight to quality after that. Generally speaking, the dollar is a high-quality currency. People therefore invest in the US dollar for safety when things are tense throughout the world. Therefore, it has already happened. The highs from a few weeks, or more precisely, a few months ago are practically right up against that trend line on this weekly chart. It briefly protruded above it before closing the following week, and that was a highly negative indicator. Now that the Russian invasion of Ukraine, all of the Federal Reserve efforts, and other factors are in play, we're virtually approaching the place where the market first spiked in 2022. The last trading pattern was broken by the dollar, and now we are returning to test it. Therefore, the area that was once resistance is now support, and it is around 106. It might not happen in the upcoming week or two if we can achieve a weekly close below 106, which I believe is possible. It can take around a month to complete, but as soon as that occurs, the ball begins to fall and we begin to move closer to 97, which would essentially just let everything else to float higher. Almost all asset classes are included in this discussion, with the exception of stocks right away. They will be the ones who answer last or most slowly, but that will be advantageous for treasuries, metals, copper, and silver. The copper industry's underlying narrative is quite persuasive. A metal used in industry is copper. When it comes to big trucks, there are many different qualities. Therefore, a lot of the new Green Deal and related issues is expected to increase demand for copper. The economy itself, which is exhibiting indications of slowing down, is most likely the only factor keeping copper prices down. And the China narrative, but everything will be resolved in the end. Therefore, anyone trying to play the copper price increase over the long term should look for support around 350, possibly 330. The chart suggests that anywhere in that area would be a good place to buy copper, and the main narrative backs that up. We've been hearing that for years, but copper and many other metals just kind of fizzled out. But a large portion of that was caused by the dollar or increased interest rates. The market will then be able to stand on its own 2 feet in terms of fundamentals and stop being constrained by a higher currency once we figure out the interest rate situation stabilizing. The Fed has been incredibly open, perhaps even too open in my opinion. It almost seems that as though they are trying to get the market to buy into their story rather than just telling us what they intend. I'm not a fan of that at all. Having said that, the Fed has been rather transparent about their actions and goals, merely pondering whether they may have already done enough or even too much, and we haven't yet noticed any impacts. The economy takes a while to adjust to interest rate increases, and we're now beginning to gradually observe the effects of their acts, and simply pondering whether they ought to possibly tap the brakes, but it doesn't matter. Everything is based on the dollar. It's kind of a go-ahead to start investing in almost all asset classes if the dollar behaves itself and closes below 116 once more. Because you get paid while you wait, treasuries are certainly one of the better plays on the board. The yield you receive is the highest we've seen in a long time, and if the economy does see a change, it will have an impact on the entire world. Most likely, your pricing increases as well. As a result, the metals are probably the best bet on the board for investors and speculators as long as we maintain support lines and the seasonal lows are in effect. Those are solid plays for the upcoming season. Thank you so much for watching this video. If you like this video, please hit the like button. Please